Good morning, everyone. As we start the week, investors are facing one of the most interesting market environments we've seen in years. On one hand, the U.S. economy continues to show strength. Last week's jobs report came in well above expectations. Inflation remains a concern. Interest rates may remain higher for longer. Meanwhile, we have ongoing tensions in the Middle East, rising geopolitical uncertainty, supply chain concerns following the earthquake in the Philippines last night, and a market that's still trying to digest one of the largest technology rallies in history. And that's where I think investors should be asking a different question. Not where can I make the most money, but where is risk actually being compensated? One of the biggest misconceptions I've encountered when talking to investors is the idea that risk is determined by the asset itself. People say stocks are risky, trading is risky, but real estate is safe, cash is safe. The reality is that every investment carries risk. The question is whether the risk is understood, managed, and properly compensated. Take the technology sector. Many of the largest AI-related companies have generated extraordinary returns over the last year. But after Friday's sell-off, investors were reminded that markets don't move in a straight line. Valuation matters, positioning matters, and liquidity matters. The same thing applies to any investment strategy. One of the questions I frequently receive is about backtesting. People often hear the term and assume it means someone simply created a hypothetical result. That's not what professional system development is. A backtest is a process used to determine whether a strategy can consistently execute its rules across multiple market environments. The goal isn't to prove perfection. The goal is to identify weaknesses, improve risk controls, and determine whether a strategy has demonstrated repeatable behavior over time. Every professional systematic strategy begins with testing. Every aircraft is tested. Every bridge we drive across is tested. Every software platform is tested. Investment systems are no different. The question is not whether something was tested. The question is whether it was tested properly. As we move through the second half of the year, I believe investors should place greater emphasis on liquidity, structure, and risk-adjusted returns. In uncertain environments, short duration opportunities, fixed income strategies, and disciplined capital allocation often become increasingly attractive because they provide visibility into both the time horizon and the expected outcome. That's especially important when markets are being influenced by interest rates, geopolitics, inflation, energy prices, and rapidly changing investor sentiment. The opportunities are still there, but selectivity matters more than ever. Preserving capital remains the first objective. Growing capital is your second objective. And understanding risk is what ultimately separates the two. Now remember, here at Celtic Capital Group, we structure capital and we build intelligent systems. Have a great week.